there. This is Elliot Wonenyika from the Child Accountants Academy, and welcome to part 3 of our lecture on standard costing and variance analysis. So in part 1, we introduced the standard costing and the principles around standard costing, as well as dealt with material variances. And then in part 2 of the recording, we dealt with sales variances and how the mechanics around sales variances, as well as the information content of sales variances. So in this part 3 of the lecture, we are going to focus mainly on fixed and variable overhead variances, as well as discuss how variance analysis can be integrated with other topics, which then we'll come to the wrap up of our lecture on standard costing and variance analysis. So fixed overhead variances. So the first thing is you need to know what is a fixed overhead. And remember, the whole concept is variance arise from we have a budget, now we've got an actual position. Then we can then have a variance, because these two most likely in fact they are going to be different amounts. So looking at our fixed overhead variance, how does it work? Okay, so our fixed overhead variances, we have a volume efficiency variance. So like I've been always saying, you need to know volume efficiency variance. And here the formula says standard hours minus actual hours times standard rate. So here we are assuming that we are using absorption costing. And to absorb the fixed overheads, we've been using, for example, labor hours, or we are using machine hours. So how many hours did we budget for? That's standard hours. But how many hours did we actually generate times the standard rate? So because of the difference between the standard hours and actual hours, I end up either absorbing more or absorbing less, therefore giving me an efficiency variance. Or another scenario that can happen is capacity, where I'm now saying my actual hours versus the budgeted hours times standard rates. So I'm saying actual production capacity was more than budgeted. Therefore, I might have ended up utilizing more, absorbing more overheads. So here the idea is I'm just trying to interpret why am I having this fixed overhead variance. And you can also link this concept to your under or over absorption concept. So here it's nothing new. So remember when we did cost classification and inventory costing, we talked about traditional costing methods, etc. So under and over absorption, that's exactly what you are doing. But you are trying to understand further, why did you have an under absorption? Why did you have an over absorption? Was it because of efficiency? Was it because of capacity utilization? And then ABC. Normally, when do we use ABC? So ABC ordinarily use it to be able to absorb fixed costs to products. So, or it's a cost allocation tool. So here I'm just saying, okay, we've done our cost allocation using ABC. And based on the standard that we had set, which is budget, and then we compare to the actual, we can then have the overhead variances arising, because the budgeted position is not different from the actual position. So example here, we are saying activity level, we are budgeting 1,600 setups, but the actual was 1,400 setups. Then capacity, we can only do a maximum of 2,000 setups, practical. Then we are budgeting total indirect fixed cost of 80,000, but total fixed cost capitalized 70,000. Variable cost 39. So now we need to calculate the cost driver rates, and normally we use the budgeted setup. So 40,000 divided by 1,000. So I'm saying we are supposed to capitalize $25 per each setup. So we do this at planning stage, and this then is our standard. To say for each setup, we are capitalizing $25 of our variable overheads. Then if we are now looking at fixed overheads, We are saying 80,000, which is the budgeted fixed overheads, divided by the practical capacity. Both are saying our fixed overheads would then move more in line with what? With the factory capacity. But variable, we expect them to move in line with activity. So $40 per setup. Now, we can then make a further assumption that production is going to take place in batches of 100 units, and that each machine needs to be set up before every batch. Actual production in units for the period is 150,000 units, and fixed costs are allocated based on practical capacity. So all these assumptions are very important for you to be able to deduce what's happening. So to explain what you're supposed to do, what gives rise to a variable overhead variance? We are saying standard cost minus actual cost, which can arise from standard hours times standard rate minus actual hours times actual rate. This is how I get actual cost, this is how I get standard cost. Then I can further break this down to expenditure and efficiency variance. So expenditure is simply saying my rate was different from the actual rate, and I'm using the actual hours. Then efficiency, I'm saying the hours were different from the standard hours, were different from the actual hours. So that I don't incorporate effects of expenditure, then I use standard rate. So it means I'm now further explaining why I have a total variable overhead variance. Then if I'm using within an ABC setup, whereby I'm calculating my variable overhead expense using setups, I'm now worried about my standard setup costs may be different to the actual setup cost. So remember in the previous example, we calculated the standard setup cost of $25, and we are saying this may be different to the actual setup cost. But I now need to further analyze why is my actual setup cost different to my standard setup cost. So it could be because expenditure or efficiency. And what do we mean by efficiency? It could be because the standard rate per setup differed to the actual rate per setup times actual setups. Or efficiency, it could be the standard setup differed from the actual setups. Maybe standard I had budgeted to say it's going to take me 1,600, but actually I took 1,800 setups. So I'm not efficient in my setups. Happy? So let's go back to our numbers. So here we are to say now, after having calculated these variances, I'm not saying variable setup expense charged products. It was this at standard. So I'm not saying, and then the total actual expense is 39,000. I want to explain this difference. It could be due to efficiency, it could be due to expenditure. Which is the whole purpose of analyzing why are the difference in my variable, why I'm having a variable overhead variance. Then it can also further be analyzed from a fixed total actual expenses. So setup expense charge products, then I do my fixed overhead capacity utilization variance and used capacity utilization and volume variance to give me this 70,000. But I really want to emphasize once again, what is important? Ask yourself, in the variance I'm measuring, what is the information content of the figure that I'm going to get? How is it helping me to understand what caused the variance that I'm getting? The another concept that I want to discuss with you is around ex post variances, which now incorporates issues around to say whenever we are doing variance analysis, we are comparing actual performance with a standard based on an environment that was anticipated when the standard was set. I would give a classical example of Zimbabwe to say maybe someone, when they were doing budgets last year in 2018, and you're trying to project 2019. Obviously, there are own projections of inflation, etc. That was the environment. But now when we come to 2019, the actual environment, in February, 1:1 was removed. In June, Zimbabwe dollar was introduced as the only currency to be used in Zimbabwe. So definitely then distorts how you do your variance analysis, which is why normally we need to take into account variances that may arise from planning, whereby unforeseen or uncontrollable events would then have happened. Then once you have taken out planning, we then now need to look at these operational. Normally these are within the control of management. And from a performance evaluation, we normally want to evaluate management on operational variances because those are the ones within their control. And normally that's why we then make use of flexed budgets, because we want to take into account planning, we want to take out planning variances. So a simple example of ex post variances. So I was saying original budget, this was our original budget. But due to unforeseen event, there was a shortage of raw material in the market, which caused the price for 1 kg to increase to 15.8 per kg for August only. These raw materials of a slightly lower quality, therefore 2.2 kg were expected to be used. The actual production sales for August 2018 was 55 units, and the profit statement is found below. So actual, I'm not saying 20 and 55. So actual profit is 409.4, budgeted 500. But now I want to say, why are we having a difference? So I can do a reconciliation of my budgeted profit against my actual profit, calculating my usage variance, my price variance, my volume variance. Then I can do my reconciliation. Actual profit is saying based on what I anticipated, isn't it? So I'm not trying to say, so from my budget, what caused me to have a difference? Then I do this reconciliation. So I'm sure you can also see that the budgeted profit that I've used is the actual budgeted profit before any flexing. But here I'm budgeting to sell 50 units. So the fact that I then sold more units is taken into account in the sales volume variance. And also because I've sold more, it definitely means I'll need to produce more. It then is also captured in my material usage variance. So all these things, so we are trying to understand why are we having a difference in profit between the actual and the budget. Now the next thing we need to do, or should be able to do, after management have finished calculating the variances, they need to be able to investigate what is the cause, what caused these variances. But the numbers themselves, without an understanding, will not allow management to improve going forward. So to be able to do this, you need to be able to understand what was the company's business model, what are the key drivers within the company. Am I able to identify relationships within the business? For example, I can have a favorable material price variance, but in adverse material usage. Why? Because I ended up buying low quality raw materials at a lower cost, but my yield then fell because I was using lower quality material, therefore giving me an adverse material usage variance. So this is now what we are trying to understand in investigating variances and coming up with the reasons for the variances. So it can be a number of things. And normally here we expect you to be able to make use of the information in the case study to come up with the plausible reasons behind the variance. So here, please, as much as possible, avoid using general information. What have you been told in the exams case study, which can give you an explanation behind why you are getting that type of variance? Then from an integration, you may apply standard costing within an ABC costing environment for the purpose of allocating variable overheads as well as fixed overheads. So variable, especially those which are the indirect ones. Now, I'm sure we discussed previous. So you find using the traditional system, we use either machine hours, labor hours, but in an ABC environment, we are now using activities to allocate overhead costs to produce units. And these are some of the variants that you can calculate as discussed previously. Then from an integration again, you find that a charge may need to estimate costs. So you can either use linear programming, issues around learning curves, how much do you incur, etc. Then from an inventory valuation, product versus period cost. So normal only production cost can be included in the value of inventory. So this will be included in the inventory at standard. Very important, standard. Then from an absorption and variable cost, it affects your fixed overhead variances as well as your sales variances, depending on what costing method you are using. Are you in a variable costing system, or are you using an absorption costing system? So if you are in a variable costing system, you use standard contribution margin and not the gross profit margin. Gross profit margin, we use it if you are in an absorption costing environment. So this whole indirect relation, there are some of the little things that may put you off as students. Say when you are now doing a question, you may be quick to use a certain formula you saw in a question, but without taking cognizance of some of these variations that can happen. So context. So cost classification. Is it a fixed cost? Is it a variable cost? If I'm using a variable costing system, should I include or should I not include? Very important. And then from a performance evaluation, here I'm not worried about responsibility centers, controllability. For purpose of doing my variance, can I distinguish controllable versus non-controllable variances? So that at least I evaluate a division based on their controllable factors, instead of trying to evaluate them on things that they can't control. So here I've got an example. A purchasing department may purchase inferior quality raw materials, and therefore more was used by the production department. So this usage variance should be attributed to the purchasing department, not to go and hammer the production department. Because the production department only used materials that were given to them from the purchasing function. So this is also how variance analysis can be integrated within performance evaluation. So I hope this lecture series from part 1 up to part 3 has been quite useful to enhance your understanding on variance analysis and standard costing. And to conclude, I want to emphasize, please avoid the temptation of simply cramming the formulas for variance analysis, but focus more on obtaining an understanding of the information content of each variance that you calculate. Why are you calculating that variance? What is the information content of that variance that you have calculated? Which is what you need to focus on when you are doing your studying. So once again, thank you very much for taking time to watch this lecture series. Hope it has been helpful. Good day.